Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, August 4th, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
Imagine looking at your portfolio and seeing a market that is just fundamentally contradicting itself.
Right.
I mean, the threat of a major geopolitical conflict suddenly evaporates, yet the price of gold, the ultimate safe haven, it just refuses to drop.
Yeah, and meanwhile, tech stocks are just exploding higher on this inflation relief trade, even as core manufacturing data is basically screaming that the broader economy is slowing down.
Exactly. So today, we're unpacking a market that seems, perfectly content to ignore economic reality in favor of pure liquidity.
Right, so we have four critical themes emerging from today's data deck that we really need to cover. First, there's this massive geopolitical relief trade. Drafted proposals for a U.S Iran Hormuz deal have sent crude oil tumbling, which sparked a major rally in government bonds.
Yeah, and second is the aggressive equity melt-up. The S&P 500 and the Dow hit all-time highs today, propelled by extreme momentum in technology and AI semiconductors.
Third, we're going to look under the hood at the actual plumbing of this rally. So exceptionally clean market positioning combined with dealer gamma dynamics is creating this classic fear of missing out or FOMO squeeze.
Right. And fourth, we're tracking a major foreign exchange wild card. We're seeing highly unusual public calls for U.S. intervention to support the Japanese yen, and we'll break down exactly what that means for global liquidity.
Moving to today's data, the primary macro driver of the session is the geopolitical unwind in the Middle East. Qatar has confirmed that a draft of proposal is in place for a U.S. Iran agreement that's explicitly designed to reopen the Strait of Hormuz.
Yeah, and the market reaction to that headline was just immediate across the Treasury curve. It triggered what we call a meaningful bull flattening. Let's look at the exact pricing.
Sure.
The 10-year Treasury yield dropped 6.3 basis points to 4.617%.
Right.
The 2-year yield dropped 4.6 basis points to 4.194%. However, the long end of the curve is showing distinct stubbornness. I mean, the 30-year yield remains historically elevated at 5.179%.
Even with today's drop.
Yeah, and that is despite a 5.2 basis points drop today.
I want to pause right there because if you're an investor trying to manage risk, terms like bull flattening can sound pretty opaque.
Sure.
So applying the first principles rule here, can you give a simple explanation of how a drafted peace agreement in the Middle East directly and immediately impacts domestic U.S. interest rates? Like, why does the bond market care so much about this specific strait?
Well, it fundamentally comes down to crude oil acting as a real-time proxy for future inflation.
Okay.
When the Strait of Hormuz is threatened, the market instantly prices in a high probability of a crude supply shock.
Because so much oil flows through there.
Exactly. And a supply shock means higher prices at the pump, higher transportation costs for almost all consumer goods, and ultimately higher broad inflation.
Right.
So when inflation expectations rise, the bond market demands a higher yield to compensate for that, diminishing purchasing power over time.
So the moment the news breaks that a deal is drafted to secure the strait, that geopolitical risk premium just evaporates from the price of oil.
Precisely. When crude drops on deal hopes, that inflation premium is rapidly stripped out of the bond market.
Yields fall.
Yields fall. And because inflation fears cool down, the market immediately reassesses the Federal Reserve's trajectory. Consequently, the probability of a September rate cut by the Fed jumped today to roughly 58%.
Which completely shifts the macroeconomic narrative for the quarter. But we also have to look at the mechanics of the bond market over the past few weeks to understand the sheer velocity of today's moves. Our daily desk data characterizes this Treasury rally heavily as a positioning squeeze.
Yeah, that is a critical component of today's price action. Over the last month, traders were heavily long on put options for 10-year and 30-year futures.
Meaning they were betting on higher yields.
Exactly. Essentially, institutional money was aggressively betting that yield would continue to rise. When this Hormuz headline hit, they were caught completely offside. They were forced to cover those bets.
Which means buying bonds.
Right, which pushes yields down even faster.
We should also touch on the international context quickly because the global rate picture is really diverging. Institutional consensus still flags a potential September rate hike for the European Central Bank, which contrasts sharply with the U.S. outlook.
Yeah, and domestically, we heard from the Philadelphia Fed's Anna Paulson today. She stated she's keeping an open mind on the rate path.
Right. She specifically cited two plausible scenarios for how current policy is affecting inflation, leaving the door open for easing if the data aligns.
Indeed, and that drop in the 10-year yield, which effectively acts as the discount rate for future corporate earnings, directly fueled today's equity melt-up. Lower yields make long-duration growth valuations highly attractive.
Let's unpack that relationship for a moment. If you're holding tech stocks, a drop in the 10-year yield is essentially adding fuel to your portfolio.
Oh, yeah.
The indices responded with historical force today. The S&P 500 closed up 1.79% at 7,736, cementing a new all-time high.
Yeah.
And the NASDAQ 100 surged a massive 3.32%.
Yeah.
But it's the sector divergence that tells the real story here. Technology, tracked by the XLK ETF, spiked 4.98%.
Yeah.
Meanwhile, defensive sectors were completely left behind. Utilities, tracked by the XLU, actually dropped 0.56%.
Yeah, we're looking at a highly concentrated rotation into growth. Looking at specific corporate movers, Palantir Technologies, PLTR, surged 30%, making it the best performer in the S&P 500 following strong forward guidance.
Huge move.
Yeah, and the semiconductor space aggressively ripped higher. ARM jumped 18%, and Marvell Technology, MRVL, gained 13%.
It wasn't a uniform advance across the broader market, though. Aptiv, APTV, plunged and was the worst performer in the index. They actively lowered their 2026 guidance, specifically citing product mix dynamics in their China automotive business.
We also saw a significant shift in alternative asset managers. Firms like TPG and Hamilton Lane, HL&E, experienced massive relief rallies today after beating estimates.
Right.
TPG notably beat fee-related earnings estimates by 20% on the back of $16 billion in fundraising. Lower interest rates reduced their cost of capital and increased the valuation multiples of their private portfolio companies, which is why that specific sector acts as a high-conviction relief play when yields fall.
We also need to factor in the post-bell earnings, which show that the AI halo effect definitely has its limits. Advanced Micro Devices, AMD, fell 8% after hours on mixed guidance. Pinterest, PINNS, dropped 7%. Conversely, Arista Networks, ANET, spiked 12% on a significant revenue acceleration beat.
Beyond the raw percentages, today's proprietary updates reveal highly specific mechanics regarding investor flows. Overall, book gross leverage saw its second largest monthly decline on record last month.
Which means institutional investors had massively de-risked heading into this week.
Exactly.
Think of the market going into today like a bone-dry forest. Because institutional leverage had been completely cleared out over the last 30 days, positioning was incredibly clean. Nobody was carrying heavy speculative risk.
Right.
So when this Hormuz headline hit, it acted like a spark in dry brush. Because there was no structural resistance or overhead supply from trapped buyers, it caused this massive, unimpeded short-covering wildfire.
Yeah, and that structural reality is being severely amplified by the derivatives market.
Okay.
Dealer desks are currently getting shorter gamma to the top side.
Right.
When market makers are short gamma in a rapidly rising market, their risk exposure expands as the index goes up. To remain neutral and hedge that expanding risk, they are forced to buy the underlying stocks or futures.
Which creates an aggressive, positive feedback loop.
Exactly. The higher the market goes, the more options dealers have to buy to hedge their books. That buying pushes the market even higher, which forces them to buy even more. It exacerbates the rally and fundamentally fuels that retail FOMO we're seeing across the tape.
Taking a quick look at international equities, we saw a similar tech-led dynamic in Asia. The South Korean Kospi Index rose 1.62%, heavily driven by its structural semiconductor exposure.
Yeah.
In China, the onshore CSI 300 outperformed the Hong Kong market, rallying largely on expectations of domestic policy support aimed at stabilizing their property sector.
Correct. And pivoting to the underlying commodity fuel, energy markets dictated the cross-asset narrative today. WTI crude fell sharply by 5.81% to $75.68 per barrel.
Right.
And Brent crude fell towards $79. All of this pricing was predicated directly on the Hormuz deal optimism.
While energy retreated, industrial and precious metals saw sustained bids. Copper remains very strong at $13,848 per metric ton. That price action is being supported by the rally in Chinese equities we just discussed, alongside the structural long-term demand required for AI data center infrastructure and broad electrification.
Yeah.
But the price action in the precious metals complex is really the puzzle of the session.
It's the most nuanced data point we're tracking today.
On that point, I want to challenge the standard market playbook here. If you look at historical models, when geopolitical risk decreases, which is exactly what the Hormuz deal implies.
Yeah.
You usually see a sharp sell-off in safe haven assets.
Sure, usually.
So why is gold holding completely firm near $4,080 an ounce today?
Right.
We did not see the standard risk-on liquidation in gold that textbooks suggest we should have.
It is a vital contradiction to unpack for anyone holding precious metals right now. Gold is currently receiving dual offsetting support.
Okay, how so?
Well, on one hand, the geopolitical risk premium is indeed unwinding, which exerts downward pressure on the metal. However, that same unwinding causes oil to drop, which eases inflation concerns. That brings forward the pricing for Federal Reserve rate cuts, driving real yields lower.
And lower interest rates decrease the opportunity cost of holding a non-yielding asset like gold.
Exactly. So the bullish impulse from the bond market pricing in an easier Fed is perfectly neutralizing the bearish impulse from decreasing geopolitical risk. It's a textbook macroeconomic tug-of-war playing out in real time.
Turning to foreign exchange and crypto, the U.S. dollar index, the DXY, dipped sub 100 today, landing at 99.89. Bitcoin rose to $64,090.
Yeah.
But the crucial FX story, and perhaps the most important global liquidity metric of the day, is the Japanese yen. The USD-JPY pair is trading at 157.75. We saw Treasury Secretary Bessent make a highly unusual public call for the Fed to actively support the FEMA repo facility to defend the yen from competitive devaluation.
Yeah, the FEMA repo facility, the Foreign and International Monetary Authority's repo facility, is a critical piece of global financial plumbing.
Right.
It allows foreign central banks to temporarily exchange their U.S. Treasury holdings for U.S. dollars directly with the Federal Reserve rather than selling them on the open market.
So why is a U.S. Treasury Secretary publicly urging another sovereign nation to use a specific liquidity facility? What's the strategic angle there?
It comes down to protecting the U.S. bond market.
Okay.
If Japan needs billions in U.S. dollars to intervene in the currency markets and support the yen, they have to get those dollars somewhere. The U.S. prefers they borrow those dollars via the FEMA repo facility.
Rather than selling bonds.
Right. If Japan simply outright sold their massive holdings of U.S. Treasury bonds on the open market to raise that cash, it would flood the market with supply and drive domestic U.S. yields significantly higher.
Got it.
Yeah, so Secretary Bessent is executing a bold public maneuver to manage global liquidity and protect domestic borrowing costs.
Understood. Now, we need to connect the dots. Across this massive drop in rates, the tech-led equity melt-up, and the sharp decline in energy commodities. What do all these simultaneous moves suggest about the broader economic regime the market is pricing in?
The cross-asset pricing today suggests the market has confidently transitioned to pricing in a conditional soft landing.
Right.
Equities are pricing in robust economic growth and massive, uninterrupted AI productivity gains. Simultaneously, the bond market is pricing in the absolute end of the inflation threat, giving the Federal Reserve the green light to ease policy and support risk assets.
But there is a significant catch to this entire regime. If you're building an allocation strategy around today's moves, you really have to acknowledge the fragility here.
Oh, for sure. This entire structural framework relies on two highly fragile pillars holding up the market. First, the drafted Hormuz deal must actually hold, pass through diplomatic channels, and be formally ratified without breaking down.
Which is never guaranteed in that region.
Exactly. And second, crude oil must fundamentally stay below $80 a barrel. If either of those pillars cracks, the inflation premium will immediately flood back into the bond market.
Yields will spike.
Yields will spike, and the valuation premium assigned to these tech mega caps will come under immediate severe pressure.
Which brings us to the glaring contradictions in today's proprietary updates. Our metrics flag this as a classic hated rally.
Yeah.
The price action is an aggressive, undeniable melt-up to all-time highs across the major indices. Yet, institutional consensus remains highly skeptical about the fundamental durability of this move.
We see the institutional skepticism validated in the actual economic data that the equity market simply chose to ignore today.
Right.
U.S. factory orders actually missed estimates by 50 basis points, coming in at negative 0.3%.
Which is a tangible softening in core goods demand across the economy.
Exactly. In a normal environment, a factory order's miss of that magnitude would introduce immediate growth concerns and likely spark a sell-off in cyclical equities.
But today, the market completely looked past the fundamental growth data in favor of the valuation re-rating driven by lower discount rates.
Yeah.
It was a pure liquidity and positioning-driven event.
Yeah.
The reality of softening factory demand took a back seat to the relief of falling bond yields.
The equity market is entirely trading the relief of lower yields rather than questioning the underlying economic reality that might be causing those yields to fall in the first place.
Right.
When yields fall because manufacturing is slowing down, that is not traditionally a bullish signal for long-term corporate earnings.
Which leaves us with a final thought to consider regarding the architecture of this market as you review your own allocations. Institutional consensus, including major fixed income desks, argues that long-dated yields, specifically the 30-year Treasury, which remains stubbornly elevated today at 5.179%, will continue to rise structurally over the next few years. That view holds regardless of what the Federal Reserve does with short-term rates in September. If that structural bear case for long bonds is correct, and the long end of the curve continues to rise, how vulnerable is this entire tech-led, all-time high valuation structure that is currently ignoring the 30-year yield entirely?
A steepening yield curve driven by the long end poses a strict mathematical ceiling to infinite multiple expansion in growth stocks. It is a defining question for asset allocation in this quarter.
Let's run a quick recap of today's core takeaways. We experienced a massive macro relief rally driven entirely by hopes for a Middle East geopolitical deal. That catalyzed a tech-led equity melt-up, fueled by exceptionally clean positioning and dealer gamma dynamics. And underneath it all, we saw a bond market caught offside in a severe positioning squeeze, ignoring weak fundamental factory data.
The durability of this all-time high now rests entirely on the geopolitical wire and the price of Brent crude.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.